Hey everyone, it's Arun Shetty and welcome back to the channel. Today we're diving into the exciting world of IPOs, initial public offerings. Ever wondered how a company goes from a small startup to a big name listed on the stock market? Well, an IPO is often that crucial step. We're going to break it all down for you in a way that's easy to understand, even if you're brand new to investing. We'll cover what an IPO actually is, why companies even bother with them, and the step-by-step process of how a company actually goes public. But it's not just about the companies, right? We'll also talk about you, the investor. We'll see how you can get in on the action, the potential risks and rewards involved, and wrap it all up with a simple example so you can see these concepts in action. Welcome to our beginner's guide to IPOs, or initial public offerings. Today we'll break down what an IPO is, why companies go for it, how it works, who can apply, the risks and rewards, and a simple example to tie it all together. So, let's start with the basics. What exactly is an initial public offering? In the simplest terms, it's like a company launching its grand opening, but instead of opening a new store, they're opening up ownership of their company to the public. Imagine you're a company like, say, Facebook back in the day. You've got a great product, you're growing fast, but you need more money to expand. That's where the IPO comes in. The company, for the first time ever, sells little pieces of itself called shares to the public on the stock market. Think of it like slicing up a pizza. Each slice represents a share of the company. People buy these shares and boom, they become part owners, also known as shareholders. Now, why would a company want to share their pizza, you ask? That brings us to our next point. Going public through an IPO is a big decision. And it's not just about raising a bunch of cash overnight. There are several key reasons why a company would choose this path. First and foremost, it's a powerful way to raise capital. Way more than you'd typically get from a bank loan. This influx of cash can fuel expansion, research and development, or even pay off existing debts. But it's not just about the money. Going public also instantly boosts the company's visibility and credibility. Think about it, being listed on the stock exchange puts them in the big leagues. Alongside established players, it's like a stamp of approval, attracting more customers, partners, and even talented employees. And let's not forget about the early investors, the ones who took a chance on the company before it was cool. An IPO gives them a chance to cash out, selling their shares and reaping the rewards of their early support. Okay, so we know why companies go public. But how does the actual process work? It's like a carefully choreographed dance with multiple players and steps involved. First, the company hires an investment bank, kind of like a financial matchmaker, to guide them through the entire process. Next comes the due diligence phase. Think of it like a financial audit on steroids, where the company's finances, legal matters, and overall health are scrutinized. This is also when they file their prospectus, a document packed with information about the company and the IPO. Now comes the exciting part, setting the IPO price. This isn't just picking a random number. It involves analyzing the company's worth, market conditions, and even investor demand. This is followed by a roadshow where the company's executives travel around pitching the IPO to potential investors. Finally, the big day arrives, the IPO launch. The company's shares are officially listed on the stock exchange and investors can start buying and selling. Now let's talk about you, the investor. You're hearing all this buzz about an IPO and you want a piece of the action. So how do you actually invest? Well, there are a few ways to get your foot in the door. The most common route is through a brokerage account. You can open one with a traditional brokerage or even use one of the many investing apps available. Once you're set up, you can place an order for the IPO shares you want. Keep in mind that not all IPOs are created equal. Some are open to the public, while others might have restrictions. You might be thinking, Arun, this sounds complicated. But honestly, thanks to technology, investing in IPOs has become more accessible than ever before. With a few taps on your phone, you can participate in the stock market and potentially benefit from a company's growth. Now, before you go all in on the next hot IPO, let's talk about the risks and rewards. It's crucial to understand both sides of the coin before making any investment decisions. Let's start with the good stuff. the potential rewards. IPOs can offer explosive returns, especially on that first day of trading. If the demand for the stock is high, the price can skyrocket, giving early investors a hefty profit. It's also a chance to get in early on a company you believe in, potentially riding the wave of their growth. But here's the catch: IPOs are inherently risky. There's no guarantee that the stock price will go up after the initial offering. In fact, it could very well plummet, leaving you with a loss. Remember, these companies are often relatively new and their future success isn't guaranteed. Okay, let's simplify everything with a real-world example. Imagine a popular burger chain that's growing like crazy. They have a few locations, but they dream of expanding across India. To fuel this expansion, they decide to go public through an IPO. They approach an investment bank, go through the whole process, and set their IPO price at 100 rupees per share. You believe in their brand and decide to invest. You buy 100 shares for a total of 10,000 rupees. The IPO launches, and due to high demand, the stock price jumps to 150 rupees per share. Congratulations, your investment just grew by 50%. Of course, this is a simplified scenario. In reality, there are more factors to consider, but it illustrates the basic mechanics of an IPO and how investors can potentially benefit. And there you have it, a beginner's guide to IPOs. We've covered everything from the basics of what an IPO is to the potential risks and rewards, and even how you can get involved. Remember, investing in IPOs can be exciting, but it's essential to do your research, understand the risks, and invest only what you can afford to lose. Don't let the fear of the unknown hold you back from exploring the world of investing. The more you learn, the more confident you'll become in making informed financial decisions. As always, thank you for joining me today. Don't forget to hit that like button, subscribe to the channel for more financial insights, and share this video with anyone who wants to learn about IPOs. Until next time, happy investing.